Hi, this is Brent with Trade Therapy, and welcome back to the Trading Couch. We're talking about Palantir Technologies. Our Clarity Spotlight last week, and our lesson was really straightforward. And that's what institutions do when a leader gets extended. When a leader gets stretched, institutions don't need a bearish thesis to reduce exposure. They typically manage participation through controlled consolidation and at times really sharp liquidity events that allows them to reset positioning without breaking the longer term trend. And Palantir is really a clear case study of that. It's a leader that can stay elevated longer than most traders expect it to. And then it can also deliver really fast, ugly resets that feels really irrational for traders that don't study the institutional business cycle, that don't consider what Wall Street's trying to manage on their end. And that leaves them in the position to be taken out of their trades prematurely. But before we get into all of that, a quick disclaimer of this video, as well as all trade therapy content, is for educational purposes only. It's not investment advice. Trading involves risk, including the risk of loss. Do your own due diligence and manage risk according to your own plan and your own risk tolerance. So the question we're going to try to answer in this video is really pretty simple. Is Palantir still in a healthy continuation phase? It's cooling off inside a trend support, or is it beginning a transition that favors a deeper reset before the next tradable advance? In our spotlight, we started with a video look back. I'm going to use a couple of charts to do a look back to early last year. This chart is from March of 2025, when the trade war and the tariff scare was really starting to kick in. We were seeing an example of one of those nasty pullbacks on high volume that allows institutions to reset positioning without breaking the trend. And what we had noticed at the time was that this was all happening before it got to this obvious profit taking level, the 1618, from the extension of the previous high low, a level that we had been tracking for quite some time. And we had taken notice back in March that this was occurring on pretty high volume, which indicated profit taking. That led us to believe that we might see an extension above the 1618 to draw in liquidity to allow institutions to take advantage of that liquidity to reposition. We had seen that kind of move in a lot of the Mag 7 as it had gone through its reaccumulation towards the end of 2024 and going into 2025. And so we thought we might see something similar in Palantir. In our last coverage that we had on Palantir was back in late July and early August. And here's the extension above that 1618 level that we had been tracking. We used the trade war pullback, this wave 4 pullback, to take another Fibonacci measurement. And we had decided that this 186 level might be the level where we might see at least a local top. We did take a short position heading into that because we did believe that there would be some consolidation at this level. What we were really watching for, though, isn't just consolidation. We were keeping an eye out for distribution. We were looking for obvious signs that would have shown up as big volume and small candles with high wicks. And those would be tells that the market was saying that liquidity is being used for selling and not for a clean continuation. And so the point of this look back is not to be dramatic. It's to frame risk correctly. Leaders can extend, but leaders can also produce these violent pullbacks or these resets precisely because they are leaders and because they do attract a lot of emotional participation, especially late in the moves. A lot of retail traders were sitting on a lot of profit here. And a lot of people were believing at this point that Palantir was unstoppable. All of those things really set up well for Wall Street, who's looking to process gains and take profit. And so if we jump over to a clean monthly chart, this is where we started our coverage this week on Palantir. The monthly really matters because it gives us an overall read of the regime and the campaign and how healthy it is. But each one of these candles is really interesting because it compresses an entire month of volatility and headlines and positioning all down into one print that tells you where price was accepted at the end of the month. So to hold these levels going in and closing out the month really tells us where the market is really accepting price. It really is the closest thing we've got to a professional decision layer. So on the monthly chart here, the story is pretty clear. After a long base building process, after Palantir stopped becoming a headline trade, it really became an accumulation campaign. That's really the phase where institutions are willing to build exposure in here when the chart's still really ugly. and sentiment becomes really skeptical. And then all of a sudden the character changes. Once that base was complete, Palantir transitioned into a sustained market phase. And this kind of move doesn't happen just because retail suddenly gets optimistic. It happens because exposure was already in place and the market began to reprice it. And so if we look back to where the monthly is at today, we're no longer at early stage markup. We're really in campaign management here. Price is holding elevated and consolidating near highs, and that really matters. Mature leaders, institutions often keep price elevated while they rebalance their exposure. So they work through, in some cases, overhead supply. What they're really doing is deciding whether the next leg is worth funding from here, or whether they need time to do more work first. So the monthly is not a promise of upside. It's a statement about what phase we're in. If Palantir were being unwound, if this was distribution, we would see clear signs of it. The first signs of distribution are going to show up in monthly behavior, not in one scary daily candle. The progress would become harder to keep into the close, but you'd start seeing more frequent closes slipping back into these moving averages. We would see some more volume signs coming in here, but right now the monthly is consistent with a leader that's being managed, not a leader that's being abandoned. So if we drop it down one level, let's go to a weekly chart. The monthly is really helpful from an overall campaign health perspective. It tells you how the regime is going. The weekly shows you how that regime is being managed. This is where you really start to see whether or not demand is stepping in and defending on these pullbacks, whether or not progress is sticking after the tests, and whether the trend framework is staying intact. This week, we also made an important adjustment to our Elliott wave count. We did not see wave 5 developing here, so we extended our wave 5 up into the Fibonacci cluster that we identified. And I want to be very clear about this. Elliott wave is not a lead analytical tool. It's not a forecasting tool. It's a way to describe how the cycle is progressing as it builds out its structure. So when the expected leg doesn't form, it's time to reevaluate your interpretation and make updates. So what does the weekly tell us now? We've updated our Elliott count, but where does that leave us? It tells us that the weekly is really kind of holding at these elevated levels while the intermediate time framework remains supportive. We're not seeing these weekly moving averages being lost. We're not seeing a deep reset like we saw during the trade war pullback. We're seeing shallow pullbacks. We're seeing tight ranges here. That allows leaders to stay extended without collapsing. Institutions can manage exposure through time and through these tight ranges, through these shallow pullbacks without needing a really dramatic candle or a really dramatic pullback. Institutions can prepare for their next move. Now, this Fibonacci cluster up here in wave 5 that we're now targeting at roughly about 350, that's not a prediction. That's simply the next decision zones where institutions are going to have to reassess. Clusters often create natural checkpoints for harvesting gains, rotating exposure, and letting volatility expand. The bigger point is what the weekly is saying about risk. The risk is a behavioral shift. Repeated pushes that stop producing clean follow-throughs, more frequent failed recoveries, and the chart slipping back into these moving averages. That's how institutions cool a leader like Palantir without ringing the bell at the top and dumping their position. Now, I want to add one short cycle mechanics concept that ties directly to this. When a leader is extended, institutions can manage risk without price failing too much. They can reduce sensitivity by controlling how price moves, not just by dumping shares. That often shows up as slower progress, tighter ranges, and more back and forth near these highs. It's really frustrating if you're trying to trade momentum, but it's normal if you're watching how exposure is being managed and how Wall Street is managing their positions, which is a great segue over into our leverage chart this week, PLTU by PLTZ, which is the leveraged long versus the leveraged short. This is not about trading leveraged products. It's about using the ratio as a positioning proxy. When we use a leveraged short versus a leveraged long ratio, we're trying to see how aggressive exposure is behaving underneath the surface. This can help separate two situations that look very similar within a price chart. The first, is there authentic funding for the next leg higher? The second, are we looking at controlled exposure where price is being held up in the underlying asset, but leverage is being managed while hedges are being quietly built. So what does the ratio tell us right now? It reads like controlled positioning. Instead of trending cleanly higher, it's chopping around its moving averages. That message isn't necessarily bearish by itself. The message is that incremental leverage isn't urgent at the moment. In plain English, the core exposure can stay on, but the marginal demand is quieter. So what would change this message? If we started to see the ratio pushing higher and holding above these shorter term moving averages, then the next push in PLTR is being actively funded. If the ratio starts to roll over, starts to lose these more intermediate averages and starts to fail back tests here, that's often what heavier hedging looks like. That would raise the odds that the next major move in PLTR is more likely to be a deeper reset phase than an intermediate continuation surge. This is the institutional literacy lesson in one line. Retail watches price and asks, is it going up or down? Institutions watch behavior and ask, is this a good place to expand exposure or is this a good place to manage it? And that's why the ratio really matters more than a headline. It keeps us honest about what positioning is doing while price is still being held up in a tight range. Let's wrap this up by jumping over to the daily chart. The daily matters because it shows you where tactics really show up. Monthly gives you a clear view of the overall trend. Weekly shows you how that trend is being managed. But the daily really shows you how pullbacks are resolving, how reclaims are behaving, and whether progress is being held or whether it's being given back. On the daily, the main message is this. PLTR is holding elevated while trend support continues to rise into price. That's not what abandonment looks like. But that's what a controlled consolidation near highs looks like. If you think about the institutional objective here, it really makes sense. After a strong campaign, the job at the highs is not to keep bidding price up forever. The job is to protect those gains, manage exposure, and decide whether or not the next leg higher is worth funding now or whether more time needs to do more work. This is where a lot of traders get trapped because high bases can feel really boring, especially after such a big run that Palantir's been on. The high base can really be the calm before the next move higher, but it can also be where the market's working through the excessive run that the asset's just been on. And so what we really need to try to do is separate between those two outcomes. And so how do you do that? Healthy consolidation tends to hold these shorter term moving averages and tends to convert the prior resistance into support. It can dip, it can test, it can frustrate, but it holds the framework. The deeper resets tend to show up as repeated failed pushes into the highs, followed by weaker recoveries. The price then gets stuck below these moving averages and stays there. And so that's really the decision rule. It's not one red candle. It's not one scary headline. It's the sequence. Are we looking at price recovering shorter term moving averages and converting prior resistance into support? Or are we seeing price held down underneath the moving averages and seeing weaker recovery attempts as price works its way down into longer term moving averages? To tie that all back to where we started off and where we left off back in August, late stage leaders can do one last push higher because it creates liquidity. That push often looks bullish on the surface, which is exactly why it works. It pulls in late buyers, it increases volume, and gives institutions the opportunity to reduce exposure into strength. If that happens, the daily chart is where you're going to see that signature. You watch how price behaves after each push. Does it hold its progress and build acceptance at that level, or is it being rejected and being pushed down and failing to hold its gains? That's what we're going to be watching out for. We don't have any current positioning in Palantir, but we are going to be watching to see how this daily chart resolves as it works its way through consolidation. We highlighted the potential for a C leg down to test these prior lows and to test the 200-day exponential moving average. That's all the time we've got for Palantir this week. We'll see you back here on the trading couch next week.